Everybody, we're back. I'm Tom Sosnoff. I am here with Dylan Radigan. This is Truth or Skepticism every Wednesday at 1 p.m. Central Time. It's Wednesday, November 15th. Mr. Radigan, how art thou?
I'm very good. We were just discussing the legendary nature of the Tasty Nation at this point. The crowd sizes, the globalism, standing room only. I mean, I think it's a testament to, one, it takes a long time to really get a big crowd going, but once you get a big crowd going, there's no way out. I also was thinking about something you said. This is maybe a couple months ago, as rates started to become part of the discussion again, and you had said to me, when you can get 4 or 5% risk free, it's very good for active trading, because who needs to take incremental risk indexing into the S&P when I can take no risk and pull 5 points? Like, if I'm going to take incremental risk, I'm better to leave the no risk reservation for more meaningful opportunity than to put myself at passive risk. And so I was just thinking about the combination of sort of the momentum of the business, and more the momentum of the generation. I think it's bigger than Tasty ultimately, but I think you're right on the cycle there. And then also the aspect of the financial conditions being very favorable to people sort of incrementally being more active. They either become risk off, I'll just put my money in 5% and I'm going to play golf or whatever. And if they're going to go engaged, they're much more likely to be an engaged participant, a la Tasty Nation, 45 days, reversion to mean, blah, blah, blah. And so all those things are in place. And it's one of those things where, as you know, there's a saying in Italy, as you know, I've been living in Italy. I have a point here, and I won't say it in Italian. You want some Italian? I'm going to give you one. I'm going to give you some bad Italian. Are you ready? Here's the theme. Here's the theme. Write it down. This is for the headline on YouTube. Ready? Here you go. Tra il dire e il fare c'è il mezzo di mare. Okay? The difference between speaking and doing is the distance of an ocean. So you can have all the potential in the world, and you can have all the people and all the technology and all the things, but at the end of the day, success and failure, as you point out, it's a fine line. Time at risk is your number one benefit, and just the ability to extend duration is very valuable, but also the ability to execute. Yeah. And the ability to execute comes down to who are your shareholders and what is your governance? How are decisions made? And what is the system for deciding who decides? It's not who's the CEO or who's the board. Yeah. Everybody has that question. The question is, who decides what the system is that produces those people? And do companies like Tesla or NVIDIA, do they have better systems for selecting talent to manage and better systems?
No, they don't have better systems for selecting talent. Every firm that I've ever been with, which is only a couple now, because we've always been, very independent. We do things a little different. But when we've been bought out, every firm I've been with hires really well and really smart people, really good people. Like that's not the problem.
Talent is almost a universal asset.
Talent and smartness is universal. Here's the difference, and this is what I've come to realize. The reason that there are Teslas of the world, the reason there are Elon Musks of the world that run certain companies differently and stuff, is that generally what I've seen is that the breakdown is on a governance overreach. So the breakdown is always about it's an overreach of governance, and that is where companies get stuck. That is where every major company with, 30 people on the board, 20 people on the board, 10 people on the board, 2-day board meetings off-site someplace, you can't take a piss without asking.
All the bylaws that restrict independent decision making.
No, I'm telling you, the CEO can't take a piss without asking for permission. The person can't do that. It all comes down to governance overreach. And the argument from the board side is, hey, we have a liability and this is our job. And the other side of that equation is, The other side of that equation is, okay, well, then we can either be a good company or a bad company. Take your choice. You know,
and again, all this on some level, right? It's sort of like, of course, right? Like if you have good parents, you have good kids. You have bad parents, you have bad. Like there's not a deep insight here.
No, there is a little bit.
But there's a practice. Like look at. I'm sorry. Let me just talk for 1 second. Because look at Bob Iger. Okay.
Yeah.
Where Disney is, arguably one of the most iconic publicly traded company in the world. One of them for sure over time.
Okay.
And Bob, one of the most celebrated CEOs in history. Bought Marvel, bought Star Wars, blah, blah, blah. And then at the end of his career, just total self-immolation, right? Terrible succession, comes back, it's a giant mess. He's lost whatever his touch, whatever his cadence, whatever his handle was in the past. Obviously, he doesn't have that handle. But all of that is a function of failed governance, and that's at the highest level. I mean, I would argue the Disney board, maybe ExxonMobil, maybe, there's not a bigger asset in the world to be on the board than a company like this. And my point is that they fail. And so what I'm trying to understand the difference, not who the governance is. Like I ran for Congress, as you know, you helped me run for Congress, perhaps.
I don't consider that help. I mean,
okay, well, anyway,
yeah.
But the point is, what I realized more than anything in running for Congress was you can vote for whoever you want, a Democrat, a Republican, an independent, Mickey Mouse, I don't care. But you don't get to choose the people who choose who runs, right? In other words, I decide if you're going to vote for Trump. I'm like, you can pick Trump or Biden, or you can pick, A or B. But you don't get to. But the question is, what is the system that creates the board member? What is the system that creates the CEO? And if you have a bad board member or a bad CEO, what is the system to replace that person? Which is where the Carl Icahns and the Gordon Geckos, like all these sort of ideas where you have these sort of lazy, risk avoidant boards and managements that are sitting on top of huge amounts of other people's money, shareholders' money, and then it breeds people. I mean, like Carl Icahn, and I'm using these as sort of hyperbolic examples.
Yeah.
But the point is, if there's not a good system to choose the CEO and the board, then you're going to invite real wealthy, powerful individuals, whether it's a Bill Ackman or a Carl Icahn or some similar actor, who's going to behave like a maniac if he likes that company because he feels you're not managing it well. And I'd like to think there's a better way to manage changing boards and CEOs than having to do hostile takeovers.
Well, we've actually addressed this before. I called it the 30-minute board meeting, and that's.
I remember. I know your solution. That's for the end of the show.
Yeah.
But I'm interested in understanding the existing system.
Yeah, the existing system I do not understand, and I consider it to be overreach. And it's so this is going to get into a much more interesting discussion, which is the governance overreach? I'm not sure I'm saying this correctly, but is the governance overreach enough of a reason for the average company to make it uninteresting to the average investor? Now I want to back up for 1 second before I finish this thought. I gave that discussion in a speech I did last week, 2 weeks ago, about risk-free rates and passive investing and things like that. I gave it at an event I was doing, and the funniest thing was that everybody looked at me glossy-eyed. They actually looked at that and they were like, "Oh, we never thought of that." It was almost like it was like a revelation.
Yeah,
like a revelation, and I'm like
a religious revelation.
Yeah, I'm like, are you fucking kidding me? This is a revelation that risk-free rates are 5%, so all of a sudden 7% doesn't look good. Is that's the revelation? Nobody else freaking thought of that. But
it doesn't take a lot to be a Greek god. You just have to say a couple things. We'll set you up in Greece and get you a robe.
So then that leads into the whole discussion of. That whole discussion then of if you have in a public company environment, okay, you're kind of trapped because you can love the company, you can love the product, you can love the people, the spokespeople, the even the CEO, as you just said.
The market sector.
The market sector, everything. But you can't control, you need a company almost that has a founder leader like a like an Elon Musk or something like that, that can actually be strong enough to bully or ride over the board in a public company, or no, I shouldn't say just the board, but that governance overreach. Otherwise, it is way more attractive. This is why private equity firms, if they find public companies that they feel are trading cheap, they're very reluctant to invest in them unless they think they're dirt cheap, because they lose control of that vision. They lose control of that reason why they made the investment. It's also why people with a lot of money prefer the private route, because you know what you're buying. So if you invest in a private company where they basically handpick a 5-person board and they control the governance aspect of it, there's no overreach, then you know what, you get what you pay for. If you're investing right, and you're
saying if it's my money and my 5 guys and gals,
that's right.
If I have governance and it's my dough, that's your best case scenario, and that's sort of your description. Elon Musk is the ultimate example.
He's the ultimate
his
example.
Board, his money.
And he's big enough in that. As percentage and all the other stuff. But for the average person that is a passive investor that is coming into the marketplace in a passive, whether it's an ETF, a fund, whether it's just you're making a passive investment in whatever it is, in an individual underlying, you did everything right, except there's no way to, there's no ranking system for seeing how these boards are rated and how the governance of each company is. So you really don't know what you're getting into, because there's no way. You can't know it. Nobody can know it.
And you look at Disney, where you're like, oh, Bob Iger is the greatest media CEO of recent history, and then all of a sudden
then you realize he's got one vote. He's got one vote out of 30.
And the whole thing's a mess. And so, but that leads me. So you're going in a good direction, which is the impact. Everything's good, but bad governance can make it's between speaking and doing lies the distance of an ocean. And the key to doing is governance.
Well, yeah, because one of the challenges, and this is one of the points that I think that one of the topics we're going to discuss today, is that the reason there's been a shrinking amount of public companies in the last 2 decades, and the reason that there's been such a high concentration of money flowing into just a few of those companies, is because if you're like, just to pick a name that people know, if you're like a Kathy Woods or an Ackman or whatever that is,
you're saying a star fund manager,
you're a star, or you think you're a star fund manager, or you are a star fund manager, whatever it is.
At least you're famous and you have a lot of money.
Exactly. Then the insight that they have is not necessarily, is this a great company? The insight they have is, can this company actually do something? Which is something that nobody ever talks about. Like all you ever hear on the big fundamental case for anything is like, this is a great industry, this is a great sector, this is the best company in that space. But you don't realize that in certain situations, an example might be IBM. Where you don't have founder-led or something, whatever it is. And you end
where
up in
it's a classic, or Jack Welch at GE was a legend as a sort of CEO board situation.
Until he tried to come back and
until same exact thing.
Of course,
exactly.
Because the governance had taken over. And so what happens in those situations is, just that you don't realize what you're actually, you don't know what you're buying. And I think,
but if I understand you correctly, you're saying the advantage of a star asset manager, I won't even use a name, but a star, is that they have a better opinion, or they have a better insight into governance and the ability to execute. That's the difference between them and me and other people. Is that what you're suggesting? I'm
suggesting that is one of the small or rare advantages that nobody talks about, that I believe that they bet on. I don't know if they feel like that's an advantage, other than I really believe that the best managers do not know if the people that they're investing in, or if the concept or idea, because I'm an efficient market theorist. So if Kathy Wood says, I love this company, blah, 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 whatever it is, she doesn't know jack shit about whether that company is going to be great or not great, because she just doesn't know, because everybody thinks their company's going to be great or anything like that. Nobody really knows. But what she may know, which other people don't even look at, which I don't even know if she does, is that whoever's running that company can do what they want to do. And then that's worth betting on. Because the only thing that separates, in my opinion, what separates success and failure is assuming that everybody's smart, assuming that everybody's got, reasonable vision and they can execute and whatever, is like, do you have the capital? Do you have the ability to do what you want to do? Can you carry out, exactly what you want to do?
100 people, 1,000 people,
exactly,
for 3 years doing whatever technology.
Yeah, like I've always said, one of the reasons that we're successful is we had a vision, we banged it out. Like, that's our vision, we did it. Some people have vision, they can't get it done.
Well, I mean, that's why I'm asking you. That's exactly why I think this is such an important discussion, and why I think you're such an important person to have it with, is because of that. You've crossed the ocean. So you understand that, like, everybody has an idea for a movie or a restaurant or whatever.
There's a billion ideas, right?
But talk to someone who's actually made and delivered a movie that everyone watched, or built and operated a restaurant that actually was didn't poison people and was profitable. Is the percentages collapses by 99.9%.
Exactly.
That's why, again, execution, as the Italians say.
Can I give you an example?
For breakfast.
I'll give you an example. So we can use sports, we'll use movies, like you said. If you take a great director, like just take a Scorsese, for example. Scorsese says, you want to hire Scorsese, you guys pick your film, you decide on a budget, and then you're done. You're basically just made your bet on Scorsese.
100 million on this guy.
100 million on this guy, and it is what it is. There's nothing else you can do.
We'll find out in 2 years.
He's not taking that job unless he gets to do what he wants to do. There's a lot of general managers in sports that say, I'll take the job, but it's my call. I get to do what I want to do. Sometimes it works out.
Plays. I decide who doesn't play.
Yeah, I decide what the makeup of the team is going to look like. That's on me. Guys don't get any. The management doesn't get any say in it. You guys only get to say how much money we can spend. It's almost the same thing. Now, you don't know if they're going to be successful or not, but you hire them based on the fact that you think they are, and then fans bet on them and they support the team based on the fact that they think. Just like if you're going to a Scorsese film because you just kind of know that this guy knows what he's doing, and you're hoping.
Netflix just gave this guy $200 million. I wonder what he did. Let's take a look.
But the governance side of that is they can't do anything. They're basically, their hands are tied. As soon as they gave him $100 million, he's done. Now, and in the world, in the corporate world, in the publicly traded world, giving the keys to the car, but there's always somebody, like in the driver, there's always somebody sitting next to you with a brake pedal.
Well, because you end up in a situation, the classic, this would be the more cynical than some of these other ones we'll talk about, is you have a management team, let's say 7 people, 5 people, CEO, CFO, COO, head of sales, whatever, like the big five, the five Mr. and Mrs. Biggs of any organization.
Sure.
And collectively, they control all the governance effectively between the board. They control the votes on the board. They control the sales channel, et cetera, et cetera. And they own less than 2% of the stock. And then you have other people who own 10%, 20% of the stock, who are unable to influence the path of that business, which I'm just circling back to that investment where you have the
skin in the game.
Icon.
Skin in the game is important, but the ability to, the skin in the game is important, but I really believe it's almost like a volatility play. It's almost like an expected move play. The reason that people don't like to invest in certain companies, like just boring companies like Telephone and Verizon, Comcast, those kind of companies, and just these big boring companies, is because they know it doesn't matter who the CEO is, doesn't matter anything, nothing matters. All that matters is whoever's running that place has no chance. They're doomed from day one. They're going to get paid.
All that matters is whether Costco can sell toilet paper.
Costco's actually the other side of it. Costco gives, a lot of freedom to their management team, but
you think that's why Costco's more successful?
Yes, 100%.
I meant to say Comcast. I'm sorry.
Oh yeah, right. And I do think that's why
we can do Comcast, or Costco.
Yeah, I think one of the reasons that Walmart is at record highs right now is because they hired a new CEO, and the new CEO took the job on the basis of, hey, you know what? I'm making the calls, and you guys have to back off, and it worked. And I think that's that's what people like to bet on. That's what I like to bet on. I just don't know, who gets to do that, who doesn't.
Right. But my question, I guess, today is, one, do you think the reason that there's less publicly traded companies and more privately held, that there's more private equity companies, is because people think they get more efficient, better ability to execute and better governance if they're not publicly traded?
Yes, I do think so. I do think you have more upside.
At the same time, you have less accountability, which may mean you have more risk of bad governance in private.
That's a risk that most investors are absolutely willing to take. You're willing to take the risk of bad governance in return for a greater upside. Otherwise, you wouldn't be an investor. You'd be investing in risk free.
Mm-hmm.
I don't think that's even. I don't even think that's even close.
Do you think that your 30-minute is there the same way that we're seeing a generational shift in attitudes towards investing, the explosion of the sort of the self-directed that we're seeing with these huge, not just the huge Tasty crowds, but a lot of the self-directed platforms have just booming. With Tasty being the best example. Do you think that we'll see a similar shift in the culture of governance, more in the Sosnoffian direction of the 30-minute board? In other words, do you believe that the current old boys network, to use a cliche, of the sort of Dow 30 board will die with this generation?
I don't think that any changes to governance are on the table right now. So under this current SEC administration and the current team there, I don't see any governance changes being lightened up. I think, what set us back, 2008 really set us back. Because there was a period of time, in kind of from, let's call it from late 80s all the way through the early 2000s, where, where you could do a lot of stuff. You could theoretically go out there and build some cool stuff, and there was capital available and all this kind of stuff. And I'm not saying there's still capital available and plenty of it, but I think that in 2008, the governance rules all changed. The risk rules all changed.
You're talking about Sarbanes-Oxley?
To a certain extent, but it wasn't just Sarbanes-Oxley. It was just the corporate demand for a whole different level of, there was a new category created. Which is
basically the mandate becoming risk aversion, risk management above all else.
Yes,
because of the capacity.
Exactly. There was a new, chief risk officer was a new title that was created in 2008, 2009. And it just, whatever version of that, it hit every company. And, and then with all the changes, the heavy layers of regulation that were thrown on top of that, including Sarbanes-Oxley and everything else, yes, I do think that changed. That changed. I think that was one of the reasons why we see less public companies today, just because of the expense involved in that, and just, that overhang, and just it's very limiting.
So there's a number, this is an abstract question, but I'll ask it, that is calculated. I forget who, OECD, one is sort of global, macro data houses. I don't know. And the number that they calculate is called aggregate efficiency. It's an aggregate efficiency ratio, and it's I'm sure hypothetical, but it's sort of inferred from underlying data.
Okay.
Of for every unit of energy that's used, so for every dollar that's invested, for every gallon of gas that's burned, for every unit of power that's used to run a power plant, what percentage of that energy is converted into active motion? So the easiest example would be for every unit of energy from a gallon of gas, what percentage of that is used to move the car across the ground versus what percentage is lost in radiated heat or friction with the road or, whatever the non-movement piece of that is. And the average aggregate efficiency for most economies in the world is around 10%. So 90% of the resources that are used to produce anything don't go to the outcome. And
Okay.
the most efficient in history, like they said, they wrote a book about it, where they couldn't believe that who do you have to believe in their data measurement, but this assumed on a relative basis, was Japan at one point. I made one of their verticals, and their aggregate efficiency was 19%, and that was considered like Tom Brady level stuff, I'm of the opinion that aggregate efficiency in terms of what for every unit in to every unit out, if you had a better system of governance, which I would define better as decisions made in the interest of a shared vision to serve a customer, as opposed to decisions made in a personal vision of how to either accumulate more power or preserve, try to not lose some prior asset, that you could have aggregate efficiencies that are even 50%. That the bit with tech that we're basically really missing a huge. My point is, I think
I agree
we're
with
missing
you.
a lot.
I agree with you, but there's no such thing as governance that is concerned about the consumer or the customer
Or the enterprise. What about Costco? What about Costco's better than Comcast?
But there's some, but let's call it very little. For the most part, you're protecting your job is to protect the franchise, not to protect the customer. So you're protecting the franchise because the thought process.
So you'd rather waste some energy to preserve the franchise than risk the franchise to be more efficient.
That's right. That's the way every business runs. Protect the franchise at all costs, and then we worry about, and the customer gets is secondary. We've always taken a very different approach. But if you want to talk about business and you want to talk about it globally, you want to see what holds everybody back. That's what holds everybody back. Is that the customer not even in the equation, and the consumer, whatever it is, not even part of the equation. It's on a governance level. Now, the CEO might be all about the consumer. The teams might be all about the consumer. But from a governance side, it's 100% about protecting the franchise.
And do you think that even I'm going to use some extremes, so this would make it more challenging for the discussion, but I would say the most extreme sort of customer-centric branding leadership in the world has been from Jeff Bezos, who's famously, anything Tom Sosnoff wants, Tom Sosnoff gets. He starts with a book, I'll get him. Like, you see what Amazon has done. But do you think that Amazon's board is on, or that's irrelevant because Jeff Bezos is another Elon Musk, and so he's a steamer. It's whatever, as long as Jeff can get people on with his vision.
I mean, when you build a multi-trillion-dollar company from nothing, you better damn have the respect of that. That's a different animal. You can't compare.
Yeah, it's a bad example.
Yeah, you can't compare Bezos because Bezos gets a hall pass on anything Bezos. You got to take the richest people in the world that are self-made out of the equation because they deserve a hall pass. Like if Bezos wants to go out, that's why when Zuckerberg wanted to go out and build his, crazy Web3,
his meta thing,
metaverse, and he blew $20 billion, people are like, I don't give a crap. Blew $20 billion, who cares? He built this up from nothing. Like I'm just saying, you don't get a say in it.
But they're exempt from governance.
Well, yeah, pretty much so. But for everybody else, they're not.
Mm-hmm. Which means, by definition, they can never be that creative, that visionary, or that. In other words, it's only a governance exemption that allows the existence of a Bezos or a Zuckerberg or a Musk or a Henry Ford, for that matter.
Yeah, but if you watch what those, there's something that's very special about the way all those people think. And I'll tell you, I gave a talk a couple of years ago, and it was to this entrepreneurial group. And they were asking questions, and a couple of us were given responses. And one of the questions was, they said between your customers and your employees, and they're both asking for things. Like your employees are asking for something and your customers are asking for something. What do you do? And I said, well, this is an easy one because it's all about the customers. Well, I don't give a crap. And I love everybody that works with us, but they're all my friends. But it doesn't matter.
But the business lives on customers. Not
I don't give a crap what anybody wants. That works here. I don't care. It doesn't make one bit of difference to me. It's all about serving the customers. It's all about the business itself. It's all about what's ever out of the front end. That's all that matters. Everything else will fall into place. And they're like, that seems kind of crude, and that seems kind of like very out of touch. I'm like, no, it's not at all. That's everyone that's how Bezos did it. That's how Musk did it. That's how all these. But
I mean, I know you're humble about it, and obviously the scale of your contribution is much smaller.
Yeah.
But the principle at work is the same.
Yeah, the principle is the exact same.
And Scott.
Yeah.
And
the principle's always been the same. Just this is who we are. Period. I don't want to hear about it.
Can that be identified?
No, I think it's really hard.
In other words, is it observable, or it's only observable if you're a billionaire hedge fund manager and you meet with the board and you know the CEO and then because you go to the country club with them in Dana Point.
I think it's observable on a private level. It is very difficult as a public company. As a public company, I only really know financial companies, but as a public company in finance, it's really hard. As a private company, it's a little bit easier because you can, because you have more one-on-one time and you can say more stuff if you're not public. But that's a tough one. Yeah.
Mm-hmm. I think that governance will change. I think the governance will change. I think that I think things like Canva. I think that as these other more efficient interactions, I think because companies that have better governance are going to be much more successful. So maybe it takes a long time, but if you have two brokerages and one has good governance and a great vision,
I agree with you.
And you have another brokerage with bad governance, even if they have a good vision, they can both have a great vision, but the one with good governance is going to win.
Yeah, the whole governance thing it's the worst. It sucks. It needs to be changed. It's outdated. It's antiquated, and it's the most.
And so this is interesting, as just with you as my friend, and it is let's of all the things that are not efficient market, mean reversion, trader, take the other side. I don't care. I don't need to know the news. I don't know the Fed. If you buy it, I'll sell it. You sell it, I'll buy it. Like just Mr. Party Boy on the floor taking the action. At the same time, if there's one thing that mentally engages him, he's like, well, who's making the decisions and what's the vision? How much money do they have and how much power do they have to execute their vision? Which I think is one of the most important things that exists in all consideration of anything, whether it's who's going to run the restaurant or who's going to run anything. And you obviously agree with that. Yeah. And so if I showed you a basically good management and good governance, and then I showed you good you have to reconcile that with efficient market theory, because this is coming from, you're saying it does matter governance and it does matter, resources, obviously. I mean, it's sort of self-evident, but at the same time, so how do you reconcile that with information is not valuable when it comes to trading?
I mean, these are I don't know. They're tough.
They're different worlds. Basically, maybe trading is so short term.
Yeah.
That governance doesn't really matter because it's about mean reversion and price extreme. And governance is a discussion over longer term outcomes, I suppose. It's different time cycles.
One of the reasons that I love trading is because none of that is part of the equation.
You get to relieve yourself of the burden of all that consideration.
That's a multi-year window. I live in a 45 day window, and most of my stuff is less inside of that. That's a multi-year window. So I don't really care.
So they're different rooms, different discussions.
Exactly. So one of the beautiful things about trading is that we get to eliminate all that crap.
I mean, I think that in and of itself is incredibly appealing, because the entire noise machine is ginned up with who's the CEO, what are the earnings, what did the Fed do, what's the economy, what's unemployment, what's CPI. I think part of the appeal of trading, as you describe it, is that it allows you to release your investment in that information, for at least for this piece of the world.
Of course, and the other piece of it, the other part to it is that, eventually investors, and you saw this with, you saw this with Bezos, you saw this with Musk, you see this with certain personalities, is they look way past. The numbers were irrelevant for how many years in Amazon. The numbers were relevant for how many years in Tesla. They were just racking up hundreds of billions of dollars, not hundreds, but tens of billions of dollars of losses, and nobody cared because people were betting on, they're betting on the player. It's a whole different world. I love that world. Yeah.
And everybody would like to exist in that world ultimately.
Yeah, I think so.
I mean, that the frustration is when you're held inside of a ring fence that's not that. Even if you're Bob Iger, who can't live in that world, right? You don't have to be just like, there's very big CEOs who still, you can be the CEO of Comcast and still have limited authority.
Yeah, no, but there's an offsetting side to that. You get paid $25 million a year to shut up. It's you always there's always a balance. Like there's always something that neutralizes. So the deal is, if you want to go build your own company, put up your own money and do your own thing. And if you want to just, if you're a smart person, a good leader, and you want to just shut the hell up and do your thing and deal with overreach of governance, then
do some corporate retreats, do some
and here's, we'll
cheerleading.
give you $25 million a year. So if you can live on $2 million a month, you'll be good with this job. I mean, I'm just telling you the way it is. That's life in the big city.
Whereas compensation for Musk is not anywhere near 25 million.
Compensation for Musk is zero. I mean, he pays himself $1.
Yeah. Mike Bloomberg was at $1.
Yeah,
for the whole time. I mean,
$1 is good. $1 is good. That's what when
you like the $1.
I do like $1. I like when CEOs pay themselves $1, because then I don't care if they pay themselves $1 and then at the end of the year their stock goes up and they make 100 billion, whatever the number is, 10 billion. I don't care, because I feel like, okay, you know what? They bet on themselves. Musk, listen, for all the negative side to Musk, the one thing he did was he pressed on himself.
He's like you said, I mean, you said this years ago in this discussion. He's the ultimate sort of double down guy who never. I mean, that's why he's a world famous. He's the legend beyond legends.
He hit a hard 8 and then he just rolled it all about hard 8 one more time. He didn't even
again 7 times in a row.
He didn't even take it off. He didn't even take it off. He just said, leave it up there and let it roll. So I can't I'm fine with that then. What pisses me off is when somebody some crazy hedge fund manager, goes out and markets up, like this year, the Nasdaq's up, 40%. They bet on the Nasdaq. They take $5 billion out next year. Nasdaq's down 40% and they lose nothing. That bothers me.
It's the opposite of $1 salary.
Yes, exactly.
Yeah. But the point is, there's not an obvious solution to this problem other than maybe going private, which seems to be the short-term solution to governance is less public companies.
Yes.
In part.
Which is what you've seen in the last 2 decades. The long-term solution is an overhaul is a governance overhaul so that companies can and again, I think the easiest thing to do is you just find ways to make people bet on themselves. So like if you want to be the CEO of a big company, listen, sure, but all you get is health insurance. And then after that,
insurance and $1.
Health insurance
and travel
and parking
and travel.
Right, whatever. You just don't get a salary. And then depending on how you do, there you go. You can make a lot of money or nothing.
But at least you won't be out a bunch of money for nothing.
Well, at least as an investor, I'm willing to,
or as a shareholder, you're not down money with no benefit.
As a shareholder, I want to bet on somebody that's willing to do that.
Of course. Which goes back to the sort of solution going back to 2008.
Yeah.
Which is the more you can line up aligned interests, meaning owner operated.
Yep.
I mean, this is, we're preaching. This is like 5th grade level sort of principles here that have been
No. I understand exactly. But listen, this was a great discussion. We're over our time here. But That was fun. That was fun. A little different than I thought.
It always is. Yeah, no, I thought I'd take you. But I heard about the private company thing. I was like, oh, this makes sense.
Yeah.
It's because it's a governance issue. And I'm back. I've been on the road. I'll be back with the Overtime boys this afternoon. So I'll be back in an hour and a half or whatever it is with Chris and Ilya. They had to survive without me for 2 days, but they made it whatever up until 2 months ago. They were fine. So I figured they could survive for a couple of days.
Yeah, they'll be fine. We've taught them how to hunt and fish. I'm Tom Sosnoff. I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. Again, we do this every Wednesday at 1 p.m. And thanks for listening. We'll see you next Wednesday. Thanks, Dylan.
All right. Bye, Tom. See you on Wednesday.